Hello and welcome to our in-depth video on exchange-traded funds, or ETFs. ETFs have become increasingly popular in recent years as a way for investors to diversify their portfolios and gain exposure to a variety of assets. But what exactly is an ETF and how are they used? An ETF is a type of investment fund that holds a collection of securities, such as stocks or bonds, and is traded on an exchange like a stock. One of the main benefits of ETFs is that they offer investors the opportunity to diversify their portfolio with a single investment. For example, rather than purchasing individual stocks, an investor can buy an ETF that tracks the performance of a stock market index, such as the S&P 500. This allows the investor to gain exposure to a broad range of stocks with just one investment. Another advantage of ETFs is their low costs. Because they are passive investments that track an index, ETFs typically have lower fees than actively managed mutual funds. This can be particularly attractive to long-term investors who are looking to minimize costs and maximize returns. But ETFs are not just for long-term investors. They can also be useful for short-term traders who want to take advantage of market movements or for investors who want to hedge their portfolio against potential risks. ETFs can be bought and sold throughout the day on an exchange, allowing investors to easily adjust their portfolio as market conditions change. Now, let's take a look at some interesting statistics about ETFs. According to the investment company Institute, as of the end of 2020, there were over 7,000 ETFs available in the US with a total of over $6 trillion in assets under management. This is a significant increase from just a decade ago when there were only a few thousand ETFs with around $1 trillion in assets. One of the fastest growing segments of the ETF market is socially responsible investing, or SRI. SRIs are ETFs that invest in companies that meet certain environmental, social, and governance criteria. According to the Forum for Sustainable and Responsible Investment, the SRI ETF market has grown by over 500% in the past 5 years. This indicates that more and more investors are considering not just financial returns, but also the impact of their investments on society and the environment. In addition to traditional stock and bond ETFs, there are also ETFs that track commodities, currencies, and even alternative assets such as real estate or precious metals. This allows investors to gain exposure to a wide range of asset classes and sectors, which can help to further diversify their portfolio and potentially reduce overall risk. So, why are ETFs so popular? One reason is their flexibility. As mentioned earlier, ETFs can be bought and sold throughout the day on an exchange, allowing investors to easily adjust their portfolio as market conditions change. They also offer tax advantages, as the gains from ETFs are taxed at the long-term capital gains rate, which is typically lower than the short-term capital gains rate. But it's not just individual investors who are taking advantage of ETFs. Institutional investors, such as pension funds and endowments, are also using ETFs as a cost-effective way to gain exposure to a variety of assets. According to a report by BlackRock, the world's largest asset manager, institutional investors now hold over $2 trillion in ETF assets. In addition to their low costs and diversification benefits, ETFs also offer transparency and liquidity. Because they are required to disclose their holdings on a daily basis, investors can see exactly what they are investing in. And because they are traded on an exchange, ETFs can be easily bought and sold, making them a liquid option for investors. However, it's important to note that not all ETFs are created equal. Some ETFs, such as those that track narrow or niche markets, may have higher fees and less liquidity. It's important for investors to carefully research and compare ETFs before making a decision. Now, let's look at some unknown facts about ETFs. One little known fact is that ETFs can also be used for short selling. This is a strategy where an investor sells an ETF that they do not own, with the expectation that the price will decline. The investor can then buy back the ETF at a lower price, pocketing the difference as profit. While short selling can be a high-risk strategy, it can also be a way for investors to potentially profit from a declining market. Another lesser-known fact about ETFs is that they can be used as collateral for loans. This is known as margin trading, where an investor borrows money from a broker to buy securities. The ETFs are used as collateral for the loan, and the investor hopes to make a profit by selling the securities at a higher price. However, margin trading also carries a high level of risk, as the investor is responsible for any losses if the value of the collateral declines. So, in summary, ETFs are a valuable tool for investors looking to diversify their portfolio, minimize costs, and take advantage of market movements. They offer flexibility, transparency, and liquidity, and are suitable for a range of investment strategies. However, it's important for investors to carefully research and compare ETFs before making a decision, and to be aware of the risks associated with margin trading and short selling. If you enjoy our videos, don't forget to hit the like button and subscribe. Thanks for watching, and stay informed.